Hey guys, what is up? Welcome back to my channel. If you guys have been watching my past few videos, you guys will know the importance of understanding and using financial ratios in determining the financial strength of companies and also how these financial ratios can indicate whether the company is fairly valued or overvalued. If you want to be able to analyze a company's financial strength, then you need to learn how to analyze a company's financial ratios amongst other things, as well as learn how to use these financial ratios to compare the financial strengths of companies against its competitors. So in this video today, I'll be sharing with you guys about the price to earnings growth ratio and explaining what it means, how to calculate the price to earnings growth ratio, and how to use the price to earnings growth ratio. With that, let's go on to my computer. Okay, I'm on my computer, so let's take a look at what a PEG ratio means. The price to earnings growth ratio, or PEG ratio, is calculated by taking the price earnings ratio divided by the growth rate of earnings of a company over a specific period of time. If you are unsure of how to calculate the price earnings ratio of a company and what it means, you can click on the link on the top right of your screen to watch my video over there. So the price to earnings ratio divided by the growth rate of earnings will give us the price to earnings growth ratio of a company. The PEG ratio is also used to determine the value of a company, and it is considered to provide a more complete picture than the PE ratio as it factors in the earnings growth rate of a company. So what does this mean, Linus? Okay, so for example, if we have two companies, company A and company B. So both companies are in the technology sector and business software and services industry. So both companies are in the same sector and same industry. So let's say company A has a P ratio of 25 and company B has a P ratio of 20. So solely based on the P ratio of company A and B, we would say that company B is more fair valued than company A, and company B represents better value for us investors. So if we solely compare the PE ratio of these two companies, then company B is said to be more fair valued than company A because company B has a lower PE ratio. However, the picture changes when we take into consideration of the company's earnings growth rate. So if company A has an earnings growth rate of 15% and if company B has an earnings growth rate of 5%, in this case, company A has a higher earnings growth rate compared to company B. So a higher earnings growth rate means that company A is expected to increase its earnings per share by a greater extent than company B in the future. So what this means for us investors and traders then is that we are likely to earn more money and returns if we own one share of company A compared to owning one share of company B. So since we as investors and traders are likely to earn more from one share of company A compared to company B, the higher earnings growth rate of the company A can justify its higher PE ratio to a certain extent. So why is this so? Because investors and traders tend to reap greater potential capital gains or greater increase in their stock prices in the future. Therefore, more investors and traders are likely to want to buy company A for its potential earnings, and therefore, the price and PE ratio of company A is likely to be more overvalued than company B. So by using a PEG ratio, which takes into account the earnings growth rate of a company, it can give us a fairer indication of the value of the companies. So if we want to calculate the PEG ratio of company A, we take the price earnings ratio, which is 25 for company A, divided by its earnings growth rate of 15%, which will give you a PEG ratio of 1.67. And to calculate the PEG ratio for company B, we take the P ratio of company B, which is 20, divided by its earnings growth rate, which is 5%. So we get a PEG ratio of 4. So okay, that's a lot of information to take in right there. So some of you might be able to take all of it in the first time. Some of you may not. So if for all you guys who didn't manage to catch it the first time, it's alright, because back when I first started, I also didn't manage to catch it the first time. So what you can do is you can pause this video here and rewatch that part and watch this video a few times to really get hold and understand the principles behind it. So the PEG ratio gives us a fairer indication of the value of a company compared to the PE ratio. And we want the PEG ratio of a company to be low. The lower, the better. So when the PEG ratio of a company is low, it can indicate that a stock is undervalued or at least not overvalued. So as with other financial ratios, there are no hard and fast figures of what constitute a good figure. So sure, any figure below 1 is ideal because that means the earnings growth rate of a company is higher than the price to earnings ratio, which makes a company fair and undervalued. However, we always want to take the PEG ratio into context, and one way to do that is by comparing the PEG ratio of companies with its competitors in the same industry and sector. So of course, we have to compare the PEG ratio of companies with its competitors to gain a fuller picture. So quick tip, when comparing financial ratios of company, we always want to compare them with other companies in the same sector and ideally in the same industry. Okay, so we have covered how to calculate the PEG ratio and how to use the PEG ratio. So let's head over and take a look at some real life examples. Alright, so I'm on Finviz right now. So Finviz is a financial website where we can get the financial data of companies. So let's take a look at some companies. Okay, so for the first company we'll take a look at is Facebook. So as you can see, we have the data for the financial data for Facebook right here. We have the price to earnings. We also have the PEG ratio. So how do we calculate the PEG ratio to get 1.51? So remember, we learned in the earlier slides that we want to first take the price earnings ratio, which is 31.94 in this case. So we key in 31.94 in my calculator, divided by the earnings growth rate. So where do we find the earnings growth rate? So when we want to find the earnings growth rate, we always take the earnings growth rate for the next 5 years as the benchmark. So in this case, we want to take the earnings per share for the next 5 years. So in this case, the earnings per share for Facebook for the next 5 years is 21.2%. So we key that down, 21.2%. So what we get will be 1.51. So let's double check. See, so we have the exact same figure as the figure provided by the website. So the PEG is 1.51. So again, how do we get the PEG ratio of Facebook? To get 1.51, we take the price earnings of Facebook, which is 31.94, divided by the earnings per share for the next 5 years, which is 21.2. So if you take 31.94 divided by 21.2, you will get 1.51. Okay, so let's take a look at another example. Let's take a look at Alibaba. Okay, so Alibaba's price to earnings ratio is 54.46. So let's key that down in the calculator. So it's 54.46 divided by the earnings per share for the next 5 years. So the earnings per share again for the next 5 years indicates the earnings growth rate. So for for Alibaba's earnings per share for the next 5 years is 3.66%. So we key that down, 3.66%. So we will get a value of 14.9. So let's double check whether we got the correct value. So as you can see, PEG is 14.88. We got 14.9, or we also get the same figure, 14.88, because we round it up to 1 decimal place, they round it up to 2 decimal place. So as you can see, that's how we calculate the PEG ratio. That is it for the YouTube video. I hope you guys have gotten value and learned something helpful. If you guys did, make sure you give a thumbs up and subscribe to my channel down below. I upload videos like this every week, and if you would like to see more stock market explained videos such as these, do let me know in the comments below. That is it with the YouTube video. I'll see you guys soon. To your financial success.